Hello, and thanks for joining us today. I'm super excited you could be here. So today we're talking about a lot of things, especially relating to real estate. And we're going to do something we never talked about on the show, which is real estate cycles, how to actually recognize them, know where we are right now, know what's coming up in the future to be able to break into real estate investing or continue to build an empire within real estate investing. You have to know these cycles, but we've never had this discussion. And so with us today is like the king of the topic, which is Logan Freeman. Now, Logan's actually the founder of LiveFree Investments, launched in early 2018 after recognizing that the corporate world really couldn't offer the fulfillment or freedom that he was seeking. So fueled by his passion for real estate, which began with a live-in flip in 2013, Logan has since built a thriving business, completing over 80 successful transactions and managing more than 13 million in investments annually. So what sets him apart really is his relentless drive and proactive communication. He believes deeply in personal growth and continuously invests in himself to stay ahead of the market trends and provide maximum value to his clients. His philosophy is what got you here won't get you there. And that drives his commitment to adapt, evolve, and serve investors with confidence and clarity. So, the proven track record and a client first mindset, Logan actually empowers investors to build wealth and security through strategic real estate investments. Logan, what's up, man? Thanks for joining us.
Man, that was an awesome bio, brother. I appreciate you getting that out to the world. It's fun to hear that, I mean, it's been a crazy 9 or 10 years of being in real estate. And people always ask me, like, what do you do? And every year has been different, right? I mean, if you think about it, like every year that I've been active in real estate has not been the same. We've dealt with a lot of different geopolitical things. We've dealt with pandemics. We've dealt with interest rates going up and down and all around. And, it's really just me trying this whole journey has been me trying to figure out, since I wasn't doing real estate in 2008, I was playing college football, right? Like, so I wasn't really thinking about real estate and the finance world and all of these different things. I got to learn from the past, right? So I can remember the future. That's what I'm trying to do, right? Is remember the future so that I can look back in the past. And I know that history doesn't repeat itself, but it often does rhyme. And that's Mark Twain, I believe. And so I try to learn from guys like Ray Dalio and Sam Zell and Steven Schwartzman and Howard Marks, right? These folks that have been in the industry for so long, and try to pull out nuggets on things that are principles that we can utilize on a regular basis to try to position ourselves successfully. And I think that doing that has allowed me to make pivots. It's allowed me to make pivots in front of market changes, which has been crucial in real estate. And it's put me in a good position. We've done close to $400 million worth of real estate now. And, that's on the brokerage side, it's on the owning and managing side. And I've just about done every asset class. So I'm just excited to be here and try to add some value to the listeners today.
That's great, man. I'm really glad you could be here because we've never even had discussion about real estate cycles. And I might be saying this wrong, but I think you talk about like what is it, an 18-6 real estate cycle? Is that accurate? What is that?
Yeah, yeah. So I mean, like you think about this, real estate has had a long history of operating within cycles, and I think it's shaped by fundamental forces of supply, demand, and here's what Howard Marks taught me: speculative behavior. Among these cycles, there is something that is called the 18.6-year real estate cycle. And I think it stands out as one of the more reliable and predictable frameworks for understanding how property markets ebb and flow. And this was popularized by economists like Fred Harrison and more recently Phil Anderson and Akhil Patel. So you definitely go read their books, The Secret Wealth Advantage, The Power is in the Land, and The Secret Life of Real Estate and Finance, because those are three incredible reads. But that framework traces its roots to a foundational economic principle that's been around for a long time, and that is Ricardo's law of economic rent. So by both understanding the mechanics of the real estate cycle and the theory of economic rent, we can gain a powerful lens for interpreting market trends and anticipating those opportunities. And, a lot of people are like, what the heck is Ricardo's law of economic rent, right? Well, I mean, it was developed by David Ricardo in the early 19th century, and it just explains how the value of land is derived from its scarcity and productive potential rather than the effort or capital put into it. So in essence, economic rent is the income earned by the land or natural resources based on its location and its desirability rather than the active improvement by the owner. So it's tied to land scarcity. And because land is a finite resource, right, which is unlike labor or manufactured goods, which can be expanded. So, give you an example, prime real estate in a central business district generates significantly higher rent than a property on the outskirts of a city, simply because of its location and access to resources, infrastructure, or population, right? And so, the reason that this matters is that land value appreciation drives the cycle. Land being limited becomes a focal point of speculative investment during periods of economic growth. That drives up prices during expansions and creates oversupply or misallocation of resources during contractions. Okay, so that speculation and mispricing, you can see that Ricardo's insights reveal how speculative behavior often detaches land values from its productive use, which leads to bubbles and eventual corrections, right? And then we have economic inequality, right? So land value appreciation benefits landowners disproportionately, right? So that widens wealth gaps, and that's a pattern frequently observed during the winner's curse phase of the cycle, which I believe is where we are at, and Ray Dalio would definitely agree with me. So I'll stop there because I just dropped a lot of information just on kind of the framework and Ricardo's law of economic rent, but I can kind of go through the whole 18.6 year real estate cycle as well if you think that's valuable, but I want to stop and pause to see if you have any
No,
questions.
I think carry on because that's what I was wanting to know is more about it. And I was also wanting to know more about the cycle where we are right now in the cycle.
Okay.
So yeah, please continue.
So, I mean, Ricardo's principles underpin the mechanics of the 18.6 year real estate cycle. And that cycle, repeats over nearly 2 decades. Okay. So that's driven by land scarcity, speculative behavior, and credit markets. And that cycle consists of 5 key phases. The first key phase is the expansion phase. This is give or take around 7 years. Please keep this in mind that this is not a specific number, right? 18.6 years is not like the exact number, but over the last 200 years or so, every 18 years, you can see these ebbs and flows, okay? But the first expansion phase is 7 years, and this is what happens here. We have a recovery from a downturn, right? So the crisis fuels economic growth and investment, and land and property values rise steadily as the confidence returns. And so connecting that to Ricardo's law of economic rent, the productive potential of that undervalued land is realized, which drives the increased demand for development. Okay, so then we have a mid-cycle slowdown. This is typically 2 to 3 years. And during this period of time, external factors, trade tensions, geopolitical risks, pandemics temporarily slow the growth, right? And so development and transactions pause, creating a cooling off period, right? So then we move into the second expansion phase, which is typically 4 to 5 years. So we have rapid economic growth is resuming. It's fueled by more speculative investment, increased credit availability. So land values are rising rapidly and development accelerates, often leading to oversupply. Well, what did we see in Austin and certain areas in California, and maybe not California, sorry, Austin, but Phoenix, Arizona is the other one that you can maybe point to, right? That's 4 to 5 years, okay? So then we move into what is called the winner's curse, right? Or the mania phase, right? And so that's kind of where I believe we're at today. So asset prices are peaking, driven by that speculative frenzy and optimism. We start to see a lot of oversupply. We start to see rising interest rates, which begin to reveal vulnerabilities, right? And so Ricardo's connection to this would be that landowners demand unsustainable rents, further detaching land values from that productive capacity. Finishing up the cycle about 2 to 3 years is the contraction phase. And in this is where the market correction or recession reduces the land values and transaction volume. So underperforming assets face financial stress, speculative excesses are flushed out, and the repricing of land values bring back in line with productive potential, creating opportunities for strategic investors. So if you think about that, right? In 2007, we went through our last winner's curse in 2007, right? The 2007 real estate peak before the GFC perfectly illustrates Ricardo's theory and the cycle in action. We had speculative frenzy. Land values skyrocketed as easy credit and overconfidence fueled those speculative investments. We had overpricing, right? Landowners demanding excessive rents, leading to a misalignment with productive use. And then there was a correction, right? So the subsequent crash reset land values, and expose the inefficiencies of that speculative behavior. Now, we all know that the GFC was a lot speculative on the financial side more than anything, right? But that credit flows is definitely a part of the land values, right? And so where we're at in 2025, I think according to the 18.6-year real estate cycle, we're currently in and or potentially exiting the winner's curse phase, entering the early stages of a contraction. And I think Ricardo's principles highlight the speculative overpricing that often defines this phase. We've seen land values have surged due to scarcity and the speculative activity in hot markets. I just read yesterday that multifamily starts are up 31%. Ty, they're up 31% in the multifamily starts. So, we are right there. Developers are going to start facing higher costs. We already seen that, right? We have financing costs. We have construction costs. We have labor costs. We've got oversupply in some areas as well, likely triggering to some corrections. I don't know. You probably know this better than me, but I've heard in certain parts of Florida, there's a lot of single family homes that have been developed that might be sitting out on the market, right? And I'm just reading headlines there, Ty. So I'm not bashing Florida. Before we started, I told Ty that I absolutely love Florida. But when national developers come in and they deliver 500, 1,000, 1,500 homes and people can't pay for them, what happens, right? They start to drop in those prices. So investors are beginning to recalibrate their expectations. They're focusing on productive potential and sustainable returns. So I think we're right there in 2025. We're going to start to see, and we already have, pricing go back up, and to the point where at some point in 2026, we're going to have a big correction, and that's going to bring a big opportunity. So what I'm doing right now is positioning my portfolio as well as consulting many other owners on how to take advantage of this winner's curse phase, right? And so that represents the peak of the second expansion phase. And the last time that we're in this position was approximately 2007. And you guys can do the math on 18 years in regards to that. So that's a good framework, I believe, that you can at least start to apply to your portfolio, Ty.
I appreciate all that, Logan, and that the detail of the stages and walking through the framework. So from where you think that we are now, like what are you doing different with your portfolio and what are you instructing, those that you teach to do based on where we are and where we're going?
Yeah, well, I think there's a lot of different things to think about, right? Well, first and foremost, I start with, hey, and I just did this kind of portfolio analysis for a couple different clients. And I said, look, when is your debt coming due? Let's start there, right? Like we need to understand when your debt is coming due. Is it in the next 2 years? Is it in the next 3 years? Because that is super important to understand when you need to start making some changes due to your portfolio. So I've given kind of this playbook for real estate investors from 2024 all the way to 2030, right? So 2024 to 2026, we're late cycle. So harvest your gains from land speculation, harvest your gains from the asset prices appreciating, refinance into fixed rate long-term debt, strengthen your cash flow on your existing properties if you are looking to hold those for a long time. Need to maintain liquidity for future buying opportunities, right? To get ready for this 2027 to 2030 correction phase where you can acquire distressed land and real estate assets. You can focus on essential sectors, right? Housing, industrial, logistics, essential retail has proven to be extremely successful. I think a lot of folks are into self-storage as well, right? And so that's kind of how I'm thinking about how to position from 2024 to 2026, getting ready for a next big buying opportunity sometime late 26, early 27.
Logan, what do you see happens when people ignore this? Like when people are not paying attention to cycles, which most people aren't, man. I have a lot of real estate guys on here, investing guys, and they're not describing, they don't understand this the way that you understand this. So like what happens when you don't? Like what are the biggest risks that these other investors are dealing with out there when they're just so disconnected from even the understanding that these cycles are there and let alone what cycle we're in?
It's a great question, Ty. And I would say this, man. Many times I hear, well, this time is different. Well, if you go read folks like Ray Dalio, he was so surprised when the dollar became off of the gold standard, right? He thought the stock market was going to drop, the world was going to end, financial crisis was going to happen. He showed up on the trade desk at the trade floor that day, and guess what happened? Stocks were through the roof, right? Prices were through the roof. And he looked at himself and said, oh my gosh, this time is not different. This has had to happen in the past. So he went back and researched when this happened the last time in the last 50 years, right? And now he's prepared, right? So I think that you have to first and foremost get through that idea that this time is different. Whatever the administration is telling you, whatever other investors are telling you, go back, find the data, find the cycles, find the history and what has happened in those periods of time. Because I was talking to an investor the other day and I said, look, to move the big ship takes a long time. You can't just turn it around, right? And our global financial economy, right, and our GDP, it takes a long time to move that ship. So you're going to have opportunities to see things happen in the residential markets before you're going to see it in the commercial, the multifamily sectors, right? Because those sectors take a little bit longer. You also will see it in the stock market before you will start to see the things happen in the real estate market. So there are ways and markers to be thinking about and tracking on a regular basis to say, man, it might be time to really start to evaluate the portfolio. I try to tell people, like, you need to be evaluating your portfolio on a quarterly basis regardless, talking to people like myself or other folks in the industry that are trading deals, they're in the market, they're in the know on what's going on. And have them do an analysis for you, right? And find somebody who can say, all right, there's a big demand for that type of product type. Your debt's coming due in the next 12 to 15 months. We need to get a plan in place. It might not be, hey, sell that deal right now. It might be, hey, that person that you've had on month to month for the last 3 years, it might be time to exit them or get them on a 12-month lease on a higher rate, right? We need to start positioning this asset to be able to sell with the highest net operating income that you possibly can. So I see a lot of people coasting on their investments because everything's working right now. But now, if the market's going to change, you need to have your foundations and your fundamentals really strong. It's the time to get your baseline and your strength underneath you to be able to weather the storm. And that might be selling off some assets. It might be creating some more liquidity. It might be, getting out of some of your real estate or other investments at this point so you can get ready for this, or refinancing some of that debt. But just remember that this time is not different. This has happened many times in the past, and there is a lot of research and a lot of data for us to go and analyze to get ready for the next downturn. And just be, I think the answer is, like, you have to be willing to say that this time is not different, and it's going to happen again. It's just when, and getting prepared for that.
Yeah, that's powerful. What do you guys do at LiveFree Investments? I know you invest, obviously, and you've done a lot of investing successfully, but what other options do you have to help other people either break into investing or, further build their empire in investing?
Absolutely. I've got a brokerage called Midwest Commercial Real Estate Advisors, and we are advising over 25 clients right now on dispositions. We work with a lot of investors that are doing 1031 exchanges, right? They're selling a fourplex at a highly appreciated. We're talking about, hey, let's look at your return on equity. Your fourplex in California, is bringing in, 3,500, 4,500 per unit, right? But guess what? Your rents have not kept up with the amount of appreciation that has happened on your property. So when you purchased it, you had a good return on equity because you didn't have much equity built up. But now you've got 45, 50% appreciation, and the income that's coming on that property does not keep up with the appreciation. Your ROE is actually pretty low. So how do we unlock that? Well, we move it into somewhere in the Midwest or some other market that you can go get 15, 25 different doors, and you can drastically increase that return on equity. Or I have a lot of investors that buy flex industrial properties, neighborhood retail shopping centers. And we're advising them on how to do that. So lots of conversations going on in regards to 1031 exchanges, as well as portfolio performance audits. What should I do with my portfolio? Should I hold it? Should I sell it? Should I refinance it? I'm going to give you an objective view. I don't need another listing, Ty. I'll work on it, but I am to the top, with my capacity in regards to the amount of deals that we are working on. So I'm trying to give true advice, and that has built a long-term relationship type of situation where people come to me and say, hey, I need your advice, because I know you're not just going to go for a listing and tell me to sell it, right? And so we're trying to do that on a regular basis. That's pretty free. I mean, I have a lot of folks that say, man, you should really build a consulting company, but I think it's more or less better just to have the resources available for folks so they can make informed decisions. And that when they get ready to make a decision and actually make a move, they're going to call you. And I've built my business on that.
What about syndications? You do stuff with joint ventures, syndications as well. Are those things? And if so, like how might that work?
Yeah, absolutely. I've done over 25 different syndications across 4 different states, spanning office, industrial, retail, multifamily, and now doing a lot of land and land development opportunities, bringing some ground up flex industrial contractor garages out of the ground, building some urban infill subdivisions, working with landowners on how to capitalize on that front. I would say this, syndications, you have to ensure that you have a good long-term plan, right? I never took any floating rate debt on any of our deals, right? And so been doing those since 2018. I have been quiet in regards to new acquisitions, and that's because I've been reading the tea leaves here, right? Asset price appreciation, NOI hasn't kept up. There's a lot of speculation going on. Debt prices have gone out. That's really pushed me out of kind of the acquisition of existing assets. So I kind of repositioned myself to say, hey, let me go learn this land. Let me understand this Ricardo's law of economic rent. And I have bought strategically some properties in the line of infrastructure development, and I have played Ricardo's law of economic rent pretty well, right? I've got a couple of properties that we have bought that we knew the streetcar was going to be moving down right in front of it. And I've been able to sell those assets at a much higher price because maybe the multifamily property didn't have parking. Well, now it has the streetcar that stops right out front. So you might not need as much parking as you would have when we first purchased that. So I've been a little quiet on the syndication side of things, just kind of getting ready, I would say, for my next buying opportunity. And I really do know Kansas City pretty well, and so I can get a pretty good sense of where and when to really make the next move. But I just don't think it's yet.
What about commercial multifamily trends? Like what are you finding in those areas that investors you're seeing are ignoring that they really should be paying more attention to?
Absolutely. I mean, first and foremost, I think that historic tax credits and opportunity zones are absolutely a strategy people need to be revitalizing and looking into. We've been doing a lot of studying and bringing some projects to market that have these tax credits. They have incentives, right? And so I have been in so many meetings with planning and zoning commissions and the finance and economic development councils talking about how do we partner public-private partnerships to make these deals make sense? What incentives are available? We have a quasi-governmental agency here in Kansas City called the Port Authority. We've got the Economic Development Council. If you're bringing new jobs into the market, then you can go get certain incentives. And where construction costs are, where labor costs are, honestly, doing new projects, it takes incentives to make those make sense. So I think that's overlooked, and it's a blue ocean strategy because many investors aren't willing to spend the time to figure out what it takes to get those deals done. And so if you are willing to do what others won't, you will be able to gather deals and create opportunities that they're not going to, right? Because everybody that calls me wants the 2000s and newer vintage, 100 plus units in a great area. I hear Class B property in a Class A area. Like that competition is very high, right? So you're going to have to pay for that. So what I'm advising is more creative deal structures. Can we get the landowner, can we get the property owner to contribute the property to a project? We bring capital to the deal, or the new buyer brings capital to the deal. We structure a joint venture. We make that asset worth more. And after 3 years, we're going to be able to stabilize and sell that deal, right? And so doing a lot more creative deal structures right now and being willing to ask those questions, I think is really important. Seller financing, also a great opportunity right now for properties that have been owned with sellers for a very long time. Do not ignore seller financing on that front. On the commercial side, the one thing that's got me most excited right now, well, two things, is flex industrial. Flex product in Kansas City has not been developed in the last 5 to 10 years. We have very big logistic hubs going in, 500,000 square feet, 1,000,000 square feet. But if you look at the trend of onshoring and nearshoring jobs in the manufacturing and logistics space, in 2011, we had about 2015, we had about 11,000 jobs onshored or nearshored. You fast forward to 2023, 357,000 jobs onshore or nearshored to the North America and to the United States. That is a huge tailwind for you to go capitalize on. How do you capitalize on it? Well, those people, they need those service vendors, those contractors, they need places for their businesses, right? And so what's been developed is big logistic hubs. What hasn't been developed is anything under 10,000 square feet. So if you can find a building and you can retrofit that, or you can take a 50,000 square foot building and chunk it down to 510s, you are going to get top of the market rents. If you can bring 14-foot doors and 16-foot ceilings, 18-foot ceilings, and bring some technology into those buildings, you are going to have tenants lining up and leasing that product up. We're doing that on a regular basis for many different clients right now as well. The other piece that I would say is very interesting is data centers. And if you are an investor and you understand transmission and powers and distribution and utility companies, huge gold mine right now is if you can find land zoned for data centers and you can work with utility companies to bring power to that site, you will be able to get paid handsomely to doing those types of deals. And so those two areas on the commercial side that got me most excited right now.
What do you think investors should be doing right now? Stay ahead of the game. I mean, you've given a pretty clear outlook of what's to happen, and you should be conserving resources and preparing to take advantage of the opportunities that are about to come. We all know the opportunities like in 2007, 6, 8, in that time frame that was there. And we always say that, in every downturn or every negative, there's all this opportunity. So what are you doing? Like, what do you advise investors? What should investors be doing right now to make the moves to prepare themselves, I think, with the liquidity they're going to need to take advantage of what's to come?
Man, you got to get into your portfolio right now. You got to get into the books. I mean, I'm working with so many owners. For the last 2 to 3 years, they've just been coasting. They'll send me financials, I'll review it, and I'm saying, hey guys, you're saying your NOI is 350. I'm seeing 125. What's going on? And they go in there and they're saying, oh my gosh, we have not done these CAM reconciliations right for the last 3 years. Get into your portfolio, call your asset managers, call your property managers, review your books, get in there. What opportunities do you see? What's the weighted average lease term on your deals right now? Do you need to be restructuring leases? When is your debt coming due? Can you refinance? Are you going to have to do a cash in refinance? Talk to lenders. Get ready for that. What deals can you sell right now to create some liquidity on the properties that you want to hold or you want to go acquire? Those are the things that I would be advising people to do. And that takes a lot of time. It takes a lot of work, and it's a lot of detail oriented. Or find somebody like myself that's willing to do that work with you to make sure that you get your portfolio ready. There's many people out there and great resources in the commercial real estate space that can help you do that.
I love it. Logan, thanks for coming on with us today. There's a lot of people out there that want to learn more about following what you're teaching, and then also want to check out the different opportunities they have to get involved with you with real estate investing to be able to help their portfolio or even launch to begin with. So where should they go? What should they do?
Yeah, I mean, thank you, Ty. I appreciate that. I'm super active on LinkedIn. You can follow me there. Logan Freeman, the Kansas City commercial real estate guy. I will pop up. I have been on there for 9 to 10 years, posting daily, trying to add value. Over 33,000 followers now. I've got a newsletter there that I post all of these insights. I write articles about the 18.6-year real estate cycle. I give market reports on the Midwest, on Kansas City, on what's going on, what I'm seeing. All of the opportunities that we have as a team are going to be pitched there on LinkedIn, and everything's on our website as well, mwcreadvisors.com. You can find everything there, and I'm very accessible. You can find me. I appreciate that.
All right. Thank you very much for coming on this day. Appreciate it.
Thanks for having me, Ty.
All right, so listen, if you're watching this, one thing you could do right now is go to livefreeinvestments.com. If you go to livefreeinvestments.com, Logan had mentioned his LinkedIn. His social media channels are right on the top right of the page. So if you go to the page, you're able to find the social media channels right there. Logan's got a great podcast as well that I think you're going to love. You're able to access his podcast there. You're also able to access other resources as well. And there's a lot of information about how you can get involved into real estate investing and the type of things that they can do to help you get involved. So it all happens in one place. That's livefreeinvestments.com. Make sure you check it out today. And again, take less than a minute because as you can see how knowledgeable he is about real estate cycles, something you've probably never heard of this depth of knowledge. So it takes less than a minute at the top right of his page just to follow him on his social channels, including LinkedIn, to get the real up-to-date information. So make sure you do that while you're at livefreeinvestments.com. Thanks for tuning in. Take care. Have a great day.